Let's talk more about the energy breakout. Joining us now is Fast Money friend Paul Sankey of Sankey Research. Paul, I know you were watching last night. You were watching Tom Lee's call. You had a thumbs up in front of your TV screen when Tom was on. So you agree with this. But what is the best way, in your view, to play this sort of super cycle in energy?
Well, I loved what you were saying about your discussion up to now has been great, and I appreciate it. And I love what you were saying about Tom Lee understating his bull case. It's very powerful when people say it so calmly and quietly. We like the E&P stocks, actually, of all the stuff that you've been talking about. The one that Tim references in terms of better management, better strategy, better assets, better balance sheets is most applicable to the E&P sector. And we've seen, for example, Devon, one of our favorites today, have a big move as they deliver results and as they deliver the right message today.
Paul, it's Karen. Thanks for being on, and you were a good call.
Enjoying the discussion. Thank you.
It wasn't an easy call. So I wonder, can you tell me, if you're as bullish as you are on the sector going forward, do you play the still levered names that would have more bang for the buck, or do you go for sort of higher quality, better balance sheets that even if there's a downturn, they'd be able to survive that better?
Well, that's a great question. And the way we've played it is cash return. What we're saying is, look, there's no trust here. It's going to take time to build trust in owning oil and oil E&P companies after what you've put us through over the past 20 years. What we want is companies like Devon that announced a special today, and pay me now and I'll ask questions later. Now, for the braver, obviously, the more bullish and levered scenario is to buy some very heavily indebted companies. A big example is obviously Oxy, because the pace of debt pay down that we're seeing is so rapid. So as you guys have referenced, and I would add a point, by the way, that what happened in 2014 was very heavily related to Saudi's strategy, which is totally different at this time. Saudi's exerting a lot of discipline on the market, whereas in 2014, they got into a market share situation that was very negative for the market. That's the big difference, in my view, between 2014 and now. But in terms of the levered names, what we've seen is some staggering debt pay down in the past quarter or 2 quarters. And the point here is that this industry basically breaks even at $55 a barrel, maybe 50 across the board. And so the difference between $55 a barrel Brent, 50 WTI, say, and what you're seeing on your screens right now, which is really 70 Brent, is all free cash flow. And so what we've really been surprised by across the board, I think, is how strong the oil price is. When it comes down to it, it's about the oil price. But then we're applying this better strategy, and that's making the sector, which, as Tommy says, is under-owned, look like it's going to have a really powerful seasonal run. Normally, we're going to get a seasonal run here into driving season anyway. It's a pretty powerful combination of effects that we're looking at. So you can buy them all, basically.
Hey, Paul, it's Tim. Thanks for joining us. So we're largely been talking about a bottom-up story in companies that are better run, but you just started to talk a little bit about the top-down, which for at many moments in history, the oil and the energy trade for the bottom-ups has been a top-down trade. What is your call on OPEC, on the resolve with an OPEC, OPEC plus, that relationship, the relationship with the U.S.? Will this hold together? Because the confidence in compliance has been a lot to do with oil prices holding here before the demand actually pulls the market higher.
Yeah, and what we've had here is total leadership from Saudi. They're very much enjoying being the central bank of oil. They're the only central bank globally that's tightening, not loosening. And what they've seen is a really dramatic win in terms of having to produce less oil, but actually have higher revenues. So everything's really going great. This past couple of weeks, we had an OPEC meeting that actually ended before it started. That's the extent to which they had made a decision before the official meeting even started. So at the moment, the OPEC situation looks very powerful. And as you know, there's going to be a very strong demand story here this summer, led by the US. We've got a situation here where Iran is probably exporting 1 million barrels a day, Libya's exporting, and India's not consuming. So you can get to a pretty powerful bull story here for oil, to the point where you start worrying about going too far to the upside, especially at this time of year when we're heading into summer, coming out of COVID. It's pretty powerful right here.
Paul, before you go, I do want to check in on some of the bold pairs trades you announced on this show. We got to do it. August 25th, 2020, you said to sell Apple, buy Exxon. That has worked out pretty nicely. Apple's up 2% versus Exxon's gain of 44% since then. January 20th, 2021, you said sell Tesla, buy EOG. Tesla's down 20%. EOG is up 28%. So what's your latest pairs trade, Paul?
I think about a month ago I came on and said buy refining. I said I was uncertain, but buy refining. So let's throw that one in there. And then I keep saying I'm going to retire. This is just too good to be true. The one that we talked about maybe was the Toto. We're very pro the energy transition. We're very pro electric cars. We want all this to happen. It's for the better of all of us. But the Toto valuation is like the internet bubble. All of this stuff is wildly overvalued, and most of it's not going to deliver. In the internet bubble, what you saw was a couple of stocks, Amazon, Apple, Microsoft, were great stocks to buy then, even at the top. But the vast majority of them were a horrible story. And many of the ones that worked, the Facebooks, the Googles, etc., didn't exist in the bubble. And that's really what we're looking at today, a very, very overvalued situation with an excessively low cost of capital. And the best grab bag of all of that is ARKK. I think it's a short. And on the other side, I think you're long the XLE or the XOP. So we're going to short ARK and we're going to go long XOP, EMP. And we've got that on let's call it a 3-month time frame.
All right.
Melissa, thanks for retweeting me, by the way. I must also mention my Twitter friends. You must join our Kenny Lay's roll call on Friday night at 8 p.m., the Twitter Rager.
That sounds kind of dangerous. I'll think about it, Paul. Thanks for the invitation, Paul Sankey. Sankey Research. Just quickly, Nadine, would you put that pairs trade on?
I would not. I just think that you've seen tech pretty soft. Energy, obviously, it's been rallying for a while. We've been owners here, but we're trimming a little bit now. Doesn't mean in the intermediate term you can't make money on that pair trade, but not after a few down days in tech. That's not the day you put that trade on. So I'd be pretty careful when I put it on and then take it off pretty fast.
Shepard Smith here. Thanks for watching CNBC on YouTube.